Welcome, Awer, Nda, Dumalang, Molo, Sobona, Hukanded, and a warm welcome to the Nduho Knowledge Cast,
That's
the
good.
podcast where your curiosity meets insightful conversations. And today we're going deep into the sometimes confusing world of IAS 12.
Oh, IAS 12.
That's the international accounting standard dealing with how companies report their income taxes.
Yeah, it's a bit like trying to decipher those ancient scrolls you find in an Indiana Jones movie. Lots of twists and turns and hidden traps.
Uh-huh.
But instead of booby traps and giant rolling boulders, we've got deferred taxes and temporary differences.
Okay, so maybe not as exciting as battling ancient curses, but for investors and anyone trying to understand a company's financial health, this stuff is pure gold.
Absolutely. Imagine trying to compare two companies, one reporting their taxes one way and the other doing something completely different. It'd be like trying to judge a rugby match with one team playing league rules and the other playing sevens.
Yeah.
It just wouldn't make sense.
So IAS 12 is like bringing in the ref, making sure everyone's playing by the same rules, and giving investors a fair view of the game.
Exactly. It levels the playing field. And because we've got excerpts from the actual IAS 12 document, we're getting the information straight from the source. No hearsay, just the facts.
All right. I'm ready to tackle those Scrum Half intricacies, but before we get into the nitty-gritty, are there any key terms or concepts we need to have a handle on to really grasp what IAS 12 is all about?
There are a few, and they're not as scary as they sound. Let's start with one you're probably already familiar with, accounting profit. Think of it as the company's earnings before SARS dips their hand in the pot.
Mm-hmm.
It's the pure, unadulterated measure of how much profit the company generated from its operations.
So the money they made before the tax man comes knocking, asking for his share of the bride.
Precisely. Now, buckle up, because this is where things get a little spicy. We've got another type of profit to consider. Taxable profit. This is the profit figure that SARS actually uses to calculate your tax bill. And here's the kicker. Taxable profit and accounting profit are often different.
Wait, hold on. My profit is my profit, right? Why would there be two different versions?
It all boils down to the fact that accounting rules and tax laws often have different ideas about how to measure certain things. They're like those relatives who come over for a braai and argue about the best way to make pap. Everyone's got their own recipe.
So it's Clash of the Cooking Titans. But give me an example. What kind of differences are we talking about?
Let's take depreciation, for example. Let's say you buy a brand new delivery van for your business. Accountants might tell you to depreciate it, meaning spread the cost over its useful life at a certain rate. But SARS might have different depreciation rules, allowing you to deduct a larger chunk of the van's cost up front for tax purposes.
Oh.
Yeah.
So you get to write off more of the van's cost in the early years, which means paying less tax now. Clever.
It's a strategy companies use to manage their cash flow, but it creates what we call a temporary difference, the heart and soul of IAS 12.
All right, temporary difference. Break that down for me like I'm trying to explain load shedding to a tourist.
Imagine a seesaw. On one side, you've got how an asset or liability is valued in your accounting books, and on the other side, you've got how SARS values it for tax purposes. These temporary differences cause the seesaw to tilt. Sometimes you're paying more tax now, sometimes you're paying less.
And IAS 12 wants to make sure those tilts are accounted for so investors can see the full picture.
Exactly. Now, when that seesaw tilts towards paying more tax in the future because of these timing differences, we call that a deferred tax liability.
Sounds a bit ominous, like a tax debt looming on the horizon.
Well, it is essentially a future tax bill the company will eventually have to pay. But on the flip side, when the seesaw tilts the other way and you might get some tax back in the future, we call that a deferred tax asset.
So it's not all doom and gloom. A potential tax refund tucked away for a rainy day.
Think of it as SARS owing you a round of drinks at the next braai. Now, understanding these terms, accounting profit, taxable profit, temporary differences, deferred tax liabilities, and deferred tax assets is crucial for navigating the twists and turns of IAS 12. So we've got our heads around the basics, the playing field, the key players, and the fact that sometimes the scorecard can look a bit different depending on who's keeping track.
Right. It's like trying to figure out who's winning between the Sharks and the Stormers when one scoreboard is showing the Super Rugby points and the other is showing the Curry Cup standings.
Yeah,
Confusing.
exactly. But IAS 12 helps us make sense of it all. Now let's dive into those temporary differences we were talking about. They're like the spice in a bunny chow. They come in different flavors and can really change the taste of things.
Okay. I'm hungry for knowledge. Hit me with those flavors. What are the different types of temporary differences?
We can break them down into two main categories. taxable temporary differences and deductible temporary differences.
Ooh, it's like choosing between a Gatsby and a samosa.
Yeah.
So which one is going to leave us feeling more satisfied on the tax front?
Well, with a taxable temporary difference, you're essentially kicking the tax can down the road.
Yeah.
You might enjoy a lower tax bill today, but it's like ordering another round of Castle Light at the pub knowing you've got a hefty credit card bill coming next month.
So it's a bit of a delayed gratification situation. Enjoying the good times now, but knowing SARS will eventually come calling for their share.
Precisely. Let's go back to that delivery van we talked about earlier. Remember how SARS might allow you to depreciate it faster for tax purposes compared to accounting rules?
Uh-huh.
That creates a taxable temporary difference because you're deducting more of the van's cost up front, reducing your taxable profit and your tax bill in the short term.
Ah, so it's a bit like getting a discount on your taxes now, but eventually you'll have to pay the full price later. But why would a company choose to do this? Is it just a case of delaying the inevitable?
Not necessarily. Think of it from a business perspective. By reducing their tax bill now, they free up cash that can be used for other things, like investing in new equipment, expanding operations, or even paying dividends to shareholders. It's all about managing those precious rands and cents.
So it's a strategic move, not just procrastination. Makes sense. Any other situations where we'd see these taxable temporary differences pop up?
Absolutely. Imagine a company that sells software subscriptions. They might receive the whole year's payment up front, but for accounting purposes, they recognize that revenue gradually over the subscription period. But SARS, being SARS, might want to tax the whole amount right away.
Yeah.
Boom. Another taxable temporary difference and a deferred tax liability is born.
Got it. So whenever there's a timing mismatch between when you recognize income or expenses for accounting versus tax, that's where the magic, or should I say the tax complexity happens.
You're catching on quickly. Now, IAS 12 has a fascinating exception when it comes to goodwill.
Goodwill. Now that sounds like a positive thing. Does this mean we can finally say goodbye to those pesky deferred tax liabilities?
Not so fast. Goodwill is that extra something special you pay for a company above and beyond its tangible assets. Think of it like the premium you'd pay for a vintage Springbok jersey signed by Francois Pioneer. It's not about the physical jersey itself, but the history, the emotional value, the intangible aura that comes with it.
So it's the intangible value that sets it apart, the je ne sais quoi, as the French might say. But how does this relate to taxes?
Well, when you acquire a company, you often pay a premium for that goodwill. IAS 12 says, in its infinite wisdom, that you don't have to recognize a deferred tax liability on goodwill when you first buy the company.
That's generous of them. Why the special treatment?
It's all about avoiding double taxation. Think about it. You've already paid a premium for the goodwill, essentially betting that it will translate into future profits. If you then had to recognize a deferred tax liability on top of that, it would be like paying tax on something that hasn't even generated any taxable income yet.
Yeah. It's like paying tax on the potential of that Springbok jersey to increase in value, even though you haven't sold it yet. Seems a bit unfair.
Exactly. So IAS 12 gives goodwill a bit of break when it comes to deferred tax liabilities.
Okay, that makes sense. So we've covered those taxable temporary differences, the ones that might lead to a bigger tax bill down the line. What about those deductible temporary differences? Those sound much more appealing.
Ah, yes. These are the ones that could lead to a delightful tax refund in the future. Think of it as SARS giving you a little something back, like a bonus at the end of the year.
Okay, now you're talking my language. When do these deductible temporary differences come into play?
Let's take a very South African example. Retirement benefit costs. Companies in South Africa often contribute to retirement funds for their employees, right?
It's like a built-in savings plan, helping everyone enjoy those golden years a bit more.
Exactly. Now, for accounting purposes, companies can typically deduct these contributions as they make them, but for tax purposes, the deduction might be delayed until those benefits are actually paid out to the employees, maybe decades down the line.
So the company has essentially paid more tax now than they should have because the tax deduction is lagging behind. Hence, the deferred tax asset.
You got it. It's like prepaying your e-toll bill and then waiting for a refund when you eventually drive through the gantries.
Finally, some good news on the tax front. But is it really that simple? Can companies just assume they'll get this refund no matter what?
Well, there's always a catch, isn't there? IAS 12 is all about being prudent, not overly optimistic. You can only recognize this deferred tax asset if it's probable that you'll have enough taxable profit in the future to actually use that deduction.
So you can't just bank on a tax refund if your business is struggling. You need a solid plan and a reasonable expectation of future profits to back it up. Makes sense. But are there any specific situations where this probability test gets a bit tricky?
Absolutely. If a company has a history of losses, like a rugby team on a losing streak, recognizing a big deferred tax asset might raise some eyebrows. It's like someone who's constantly borrowing money from their friends, claiming they'll have no problem paying it back when they win the lottery.
A bit far-fetched, maybe.
Exactly. IAS 12 recognizes this and requires companies to provide convincing other evidence that they'll actually be profitable enough to use those deferred tax deductions. It's not enough to just cross your fingers and hope for the best. You need a solid game plan to turn those losses into wins.
So a history of losses doesn't automatically disqualify you, but you need to show the ref and the investors that you're serious about making a comeback. No more relying on Hail Mary passes. Okay, this is all making sense now. But I'm curious, what happens when we throw investments into the mix? Do temporary differences also come into play when a South African company invests in a subsidiary, maybe somewhere exotic like Mauritius? So last time we were talking about those tricky deductible temporary differences, and you were about to explain what happens when a South African company starts investing in subsidiaries. Does IAS 12 still apply when profits are being made in another country?
Ah, yes, the world of international investments. It adds another layer of complexity to the mix, but the fundamental principles of IAS 12 still hold true. It's like biltong. No matter where you enjoy it, it's still biltong.
I like where this is going. So let's say a South African parent company decides to spread its wings and invests in a subsidiary, maybe somewhere sunny like Mauritius. What happens then?
Well, imagine our South African parent company is a majestic lion surveying its territory. It spots a promising opportunity in Mauritius, maybe a juicy zebra herd, and decides to send its cub, a smaller but agile subsidiary, to hunt there. The cub, being skilled and efficient, successfully brings down a zebra and enjoys a hearty meal, representing the profits earned by the subsidiary in Mauritius.
Okay, so the subsidiary is making profits. But does the lion get to share in the feast right away?
Not necessarily. The cub might decide to save some of that zebra meat for later, maybe stash it away for a leaner season. In business terms, the subsidiary might reinvest those profits back into its operations in Mauritius or simply hold on to them for strategic reasons.
So those profits are technically owned by the parent company, but they haven't been brought back to South Africa yet.
Yeah.
What does that mean for our tax situation?
This is where IAS 12 gets really interesting. Those undistributed profits of the subsidiary create a temporary difference for the parent company. Remember our seesaw? Well, it's tilting again because even though those profits technically belong to the parent company, they haven't been taxed in South Africa yet.
So it's like a tax holiday.
Yeah.
They're earning profits in Mauritius, but haven't faced the South African taxman yet. Does this mean a deferred tax liability is automatically on the cards for the parent company?
You'd think so, right? But here's the twist. IAS 12 throws us a curveball. The parent company doesn't always have to recognize a deferred tax liability on those undistributed profits.
Hold on. Really? Why not? It seems like they're getting a free pass.
It all boils down to control. Our majestic lion, the parent company, still has the ultimate say over when, or even if, those profits get distributed back to South Africa. It's like the lion deciding when to call the cub back from the hunt and share the spoils.
So because they have control, they can essentially delay the inevitable tax hit. That's a pretty powerful tool for managing their tax obligations.
It is. It gives companies flexibility and allows them to optimize their tax strategy based on their overall business goals.
This is starting to feel like a game of chess, with companies strategically moving their pieces around the board to minimize their tax exposure. But how do they actually put a number on these deferred taxes? It seems like trying to predict the future, especially with tax laws and rates constantly changing.
You're absolutely right. It's like trying to forecast the weather in the Drakensberg, unpredictable and potentially treacherous. The basic rule is that you measure deferred taxes based on the tax rates you expect to apply when those temporary differences reverse. In other words, when that income finally gets taxed or that expense is deducted.
So if the tax rate in South Africa is expected to increase in the future, the deferred tax liability would be higher.
Precisely. But as you pointed out, predicting the future is a tricky business. Tax rates can change. Governments can introduce new taxes, like those sugar taxes we've seen, and even the company's own plans can shift.
It's like trying to plan a road trip with those unpredictable potholes and detours.
Exactly. And just to add another layer of complexity, IS 12 has a rule that throws a wrench in our forecasting efforts. It says you can't discount deferred taxes.
Hold up. Discounting. What does that even mean in the context of taxes?
Discounting is a way of adjusting the value of future cash flows to reflect the time value of money. It's the financial equivalent of saying a rand today is worth more than a rand tomorrow.
Okay, that makes intuitive sense. So why can't we discount deferred taxes since they're happening in the future?
ISS 12 says it would make things too complex and potentially inconsistent. It's like trying to compare a plate of bunny chow in Durban to one in Cape Town. Different ingredients, different sizes, different prices. It's just not a fair comparison.
So no fancy financial wizardry allowed, just straightforward calculations based on current tax rates and laws. Got it.
Exactly. It keeps things transparent and comparable, even if it means sacrificing a bit of precision.
Well, this deep dive into IAS 12 has certainly been enlightening. Who knew income taxes could be so, well, interesting?
I told you, it's a fascinating world once you start peeling back the layers.
So, to sum up our adventure through the wilderness of IAS 12, what are the key takeaways we should remember?
First and foremost, IAS 12 is all about bringing order and transparency to the often confusing world of income tax reporting. It's a global standard that aims to level the playing field for investors and ensure everyone's playing by the same rules.
Right, no more hiding the biltong.
Exactly. Remember, it's all about understanding those temporary differences. Deferred taxes can either increase or decrease your future tax bill, depending on whether you're dealing with a deferred tax liability or a deferred tax asset. And when it comes to recognizing those deferred tax assets, companies need to be realistic about their future profitability and have a solid plan to back it up.
No more wishful thinking or relying on winning the lottery.
Precisely. And finally, when it comes to investments in subsidiaries, control is key. The parent company's ability to influence the timing of profit distributions gives them a powerful tool for managing their overall tax strategy.
It's like a game of strategy with companies carefully considering their moves to optimize their tax position. Well, this deep dive has certainly given me a newfound appreciation for the complexities of income taxes and how companies navigate this intricate landscape.
It's a journey full of twists and turns, but with a little guidance from IAS 12, it's a journey worth taking.
Absolutely. A big thank you to our expert for guiding us through this fascinating world. And to our listeners, thank you for joining us on this deep dive into the world of IAS 12. Until next time, happy investing.